Tampa car dealership abruptly closed its doors today, leaving already frustrated customers wondering what to do next.
The collapse already started, and it's spreading faster than anyone expected. Car prices are rising, incentives are gone, loan approvals are crashing. On paper, everything looks stable, but inside the industry, panic is setting in. Dealerships are drowning in unsold inventory, and automakers are making moves they swore they'd never make. Nobody's talking about it, but millions are about to feel it. Why is demand vanishing overnight? How did financing go from easy to impossible? And why are brands preparing for an endgame they won't admit out loud? Because by the time this video ends, you'll understand. This isn't just a market correction. It's the collapse we've been warned about. And now it's here. The car market just broke, and no one can hide from it. This isn't a slowdown. It's not a slump. It's the beginning of a collapse, and it's already ripping through the entire car industry. For years, the market has been walking a tightrope, balancing record-high vehicle prices with aggressive financing tactics and artificial incentives. But now that rope has snapped. There's no soft landing in sight. Across the United States, every major automaker, every regional dealership, and every corner of the financing world is being dragged into a vortex. Prices are rising, yet sales are falling. Incentives are evaporating just as buyers are being hit with sky-high interest rates. It's a chain reaction with no brakes. The problem isn't just one brand misfiring. This is systemic. It's not about Ford or Nissan or Subaru. It's about a structure collapsing under the weight of its own contradictions. What makes this collapse so dangerous is that it doesn't look like a collapse yet. The signs are scattered and misleading. One dealership closes, one brand cuts its forecast, one buyer walks away from a deal. But when you put those events together, they reveal a machine breaking down in real time. Consumers who were once conditioned to buy every 3 to 5 years are now sitting on the sidelines. Dealers who used to move inventory in weeks are watching it sit for months. And automakers are still clinging to the idea that this is all just a temporary slowdown. It isn't. This is the car market reaching its limit. The illusion that this was just a pricing correction or a post-pandemic plateau is gone. Underneath the surface, the system has already cracked. Sales are no longer predictable. Buyer behavior is shifting in ways that legacy manufacturers can't model. And banks, they're starting to run the other direction. And what looked like a small shift was only the first fracture. If you're feeling the pressure of rising prices or higher loan rates, you're not alone. Subscribe to stay ahead of this collapse and get the inside scoop on what's really happening in the car market. The panic buy that backfired. They bought early out of fear. Now the summer is empty, and so are the showrooms. In the first quarter and second quarter of this year, sales appeared to rebound. Some analysts called it a comeback. Dealerships held on to the idea that shoppers were returning. But that illusion was built on one dangerous misunderstanding. Those sales weren't real demand. They were front-loaded panic. As whispers of tariff hikes, rising interest rates, and vehicle shortages grew louder, consumers who were on the fence sprinted into showrooms. Many of them weren't planning to buy until later in the year, but they jumped in early, trying to beat the storm. The result was a spike in activity that automakers interpreted as recovery. It wasn't. It was fear. This pull-forward effect drained the summer pipeline dry. Consumers who would have filled showrooms in July or August had already made their move in March or April. That means the traditional sales curve has flattened. Dealers, expecting another wave, are now staring at empty showrooms and ballooning inventory. The damage is deeper than just missed sales targets. Automakers responded to the early year spike by ramping up production and setting higher volume expectations. Inventory was shipped. Advertising campaigns were launched. Forecasts were inflated, and now there's no one left to buy. Dealers across the country are reporting more foot traffic from browsers than buyers. Shoppers are test driving, asking questions but walking away. The sense of urgency is gone. That's what happens when the market exhausts its own future. Consumers who planned to buy in the summer already did, and now the industry is left holding the bag. They mistook fear for growth, and it set the stage for collapse. Price shock meets credit collapse. Cars got more expensive, loans got more expensive, and the market slammed shut. What we are witnessing is not just a pricing problem or a credit squeeze. It's the brutal combination of both happening simultaneously. And the result is a market that no longer makes sense to the average American buyer. Automakers, grappling with rising material costs and a volatile global supply chain, raised their prices across the board. Tariff pressures hit harder than expected, whether it was steel, semiconductors, or foreign-built components. The costs were passed on to consumers in the form of higher sticker prices. At the same time, incentives, once used to soften the blow, have been scaled back dramatically. The average vehicle price is now higher than ever, yet buyers are being offered fewer breaks, fewer rebates, and virtually no 0% financing. And just as prices climbed, the cost of borrowing exploded. Interest rates on auto loans have risen sharply, pushing monthly payments beyond reach for middle-class buyers. Banks, meanwhile, are retreating. Loan approvals are down. Risk tolerance is tightening. Subprime approvals have nearly vanished, and even prime borrowers are facing more scrutiny. In short, consumers are being asked to pay more for less and finance it at a higher cost than any point in recent history. This is not sustainable. The monthly payment shock alone is enough to derail even the most motivated buyer. Vehicles that were once affordable are now locked behind 4-digit monthly payments. Buyers are staring down offers they can't justify, and they're walking away. And as the metal sits unmoved, the real financial damage begins. Negative equity just killed the upgrade cycle. They are not just underwater, they are stuck. Across the country, millions of car owners are discovering that the vehicle in their driveway is worth far less than the debt still attached to it. Some owe $10,000 more than the car is worth. Others are buried under $15,000 or even $20,000 of negative equity. These are not isolated cases. This is now a national pattern, and it is destroying the foundation of the car market, the upgrade cycle. For years, the auto industry thrived on one simple rhythm. A customer would buy a vehicle, make payments for 2 to 3 years, then trade it in for a newer model. Dealers would roll over small amounts of negative equity into the next loan. Lenders would approve it, and the cycle continued. That cycle is now broken. The debt is simply too deep. Dealers cannot roll over $15,000 in negative equity. Banks are walking away. And customers? They are realizing there is no way out except to wait 5, 6, or even 8 years just to break even. Refinancing is no longer a safety valve. Trade-ins are dead, and for many, even selling the car outright would not cover what is owed. It is a financial trap, and for the auto industry, it is catastrophic. With trade-ins frozen and new loans harder to justify, dealerships have lost the most important driver of volume, the returning customer. That rhythm that once kept showrooms full has stopped, and without upgrades, the whole retail model grinds to a halt. But the problem does not end with buyers who are stuck. It worsens with the ones who are walking away completely. The auto loan default spiral. It started slowly. A missed payment here, a 30-day delinquency there. Then, quietly, the numbers began to spike. And now the default spiral is impossible to ignore. Auto loan delinquencies are surging across every credit tier, not just subprime borrowers, even consumers with good credit scores. Steady jobs and newer vehicles are beginning to fall behind. The system is cracking from the inside. For years, lenders could count on steady repayment. Even during hard times, consumers prioritize their vehicles, but the cost of living has surged. Insurance premiums are rising. Gas is not cheap. And auto loans, which once felt manageable, now stretch beyond what many households can sustain. 36% of new borrowers now have monthly payments over $700. That is not sustainable. Not with food, rent, and healthcare climbing too. And as defaults increase, lenders are getting nervous. Approvals are tightening. Borderline buyers are being turned away. Pre-approvals are being revoked. Entire groups of potential buyers are finding themselves locked out of the financing system. Without access to loans, the showroom becomes a graveyard of unaffordable options. The buyer might be willing, but the bank is not. This shift is hitting dealerships hardest. They are watching as qualified traffic dries up. People still walk onto the lot, test drive, ask questions, but when the financing check comes, the deal falls apart. It is not about inventory anymore. It is not about pricing. It is about credit access, and that is evaporating. And when the financing dies, the dealerships follow. Still, the most disturbing part is this. Wall Street did not just see it coming, they celebrated it. The collapse hidden behind the headlines. The headlines said everything was fine. Auto sales were back, inventories were growing, consumers were buying again. But under the surface, a very different story was unfolding, one that Wall Street refused to see. Because the sales numbers, they were a mirage. And the industry, it was propping itself up on smoke and mirrors. Automakers were not selling to consumers. They were unloading vehicles into rental fleets, corporate accounts, and short-term export channels. Fleet sales skyrocketed while retail demand withered. But fleet sales don't drive dealership profits. They don't generate trade-ins, and they don't reflect true consumer confidence. They just move metal off the books and give the illusion of momentum. Then came the incentives game. Dealers quietly loaded cars with bonus packages, phony add-ons, and renamed fees. Paint protection, wheel locks, nitrogen tire kits, all of it designed to disguise a rising MSRP and pad margin, while pretending to offer value. Meanwhile, buyers faced sticker shock and walked away. Sales teams blamed tariffs, buyers blamed greed. But the truth was simple: no one could afford the car anymore, and the numbers were being dressed up to hide it. And yet, analysts cheered. Earnings beat expectations. Stock prices held steady because no one wanted to admit what was happening behind the scenes. The real buyers were gone. The market was hollowing out, and while investors cheered, the real buyers vanished. Now the damage can no longer be hidden. The metrics have cracked, and the next chapters of this collapse will no longer be written in balance sheets, but in bankruptcy filings. Nissans Meltdown is only the first domino. Once considered one of Japan's global automotive powerhouses, Nissan now stands at the edge of collapse. A company that once exported confidence and efficiency is liquidating core assets in a last-ditch effort to stay alive. Internal sources have confirmed what the headlines only hinted at. Nissan may sell its global headquarters and lease it back, a desperate maneuver to generate emergency cash flow. This isn't a restructuring. It's survival mode. Just months ago, Nissan had a potential lifeline, a merger deal with Honda. The combined entity would have become the third largest car maker in the world, but Nissan walked away. At the time, executives claimed independence was the stronger path. That gamble aged poorly. In the months since, Nissan's profits have plunged by over 90%. Its balance sheet is deteriorating, and the cash runway is evaporating fast. Now, analysts who were cautiously optimistic are openly wondering whether Nissan will even exist in its current form a year from now. Insiders say the board is fractured, leadership is panicked, and no outside investor wants to touch a brand bleeding this badly. Worse still, the vehicles themselves are piling up on lots, unsold and increasingly unwanted. Even with $4,000 off sticker prices, the brand's reputation is too battered to recover quickly. And without a buyer for the company, or at least its best assets, Nissan may not last through the coming fiscal year. And one brand's collapse sent shockwaves through the entire sector. Tariffs hit every brand harder than anyone admits. What started as a few isolated pricing adjustments has now turned into an industry-wide scramble to survive the fallout of rising trade tariffs. Manufacturers across every segment, luxury, economy, electric, and gas, are hiking sticker prices, trimming features, and slashing production targets. The excuse is always the same: increased costs. But behind closed doors, executives are panicking over what comes next. Subaru has already confirmed a $2,000 increase on some of its most affordable models. Ford warned investors that tariffs would hit vehicle pricing directly and force them to reduce incentives. Audi was among the first to raise prices in response to European and Asian supply disruptions. And now nearly every automaker is following suit, not because they want to, but because they have no choice. Tariffs have added unpredictable volatility to material and parts costs, and no brand, no matter how large, can eat that expense forever. Some are disguising the increases as technology upgrades or enhanced safety packages. Others are being more transparent, publicly blaming tariff policy. Either way, the result is the same. Consumers are paying more, getting less, and losing patience fast. In a market already suffering from buyer fatigue, this price shock is gasoline on the fire. The cruel irony is that while prices rise to protect automakers' margins, volume drops. The more they raise prices, the faster the buyers disappear. The faster the buyers disappear, the worse their financials look. This is a spiral, one that even legacy brands like Ford and Audi cannot simply ride out. And while automakers raise prices to survive, buyers vanish in protest. The death of the dealership. Across the country, dealership owners are quietly laying off staff, reducing operating hours, and bracing for impact. The problem isn't just that buyers are gone, it's that the inventory is still arriving. Thousands of new cars sit unsold on lots that are already over capacity. Floor plan financing, which dealers rely on to hold inventory, is becoming more expensive by the month. And with higher interest rates and slower turnover, Dealerships are bleeding cash. In normal times, automakers support dealers with incentives, co-op advertising, and special financing terms. Not this time. Manufacturers, themselves in financial distress, are pulling back on dealer support and shifting the burden onto franchise owners. The result? Small and mid-sized dealers are being crushed under the weight of inventory they can't move and loans they can't cover. To stay afloat, some dealers are resorting to predatory pricing schemes, markups disguised as nitrogen fills or paint protectant packages. But buyers are catching on. Others are slashing prices, sometimes below cost, just to generate foot traffic. But it's not enough. Dealers who once survived on volume are now watching their margins disintegrate. Consolidation is already happening. Regional chains are absorbing struggling independents. Family-owned stores are selling out or shuttering, and the human cost, lost jobs, shuttered showrooms, declining local tax revenue is just beginning to register. This isn't a temporary market correction. It's the unraveling of an entire retail network that powered the car economy for over a century. And when dealerships fall, towns, jobs, and communities go with them. The vanishing consumer. The most dangerous part of the current collapse isn't rising prices, high interest rates, or even inventory overload. It's something deeper, psychological. Consumers are no longer merely waiting out a bad economy. They're reassessing whether they want to buy a new car at all. The vehicle as status symbol is being replaced by vehicle as liability. This cultural shift could devastate the auto industry more permanently than any tariff or tax. Where buyers once traded in vehicles every 3 to 4 years, they're now holding on for 6 to 8 years or longer. It's not just about affordability. It's about trust. Consumers no longer believe they're getting a fair deal. Loan terms have ballooned. Repair costs have soared. Insurance premiums are at record highs. And for many, the idea of committing to a $600 per month payment for the next 7 years just feels like madness. This erosion of trust and enthusiasm has generational implications. Younger buyers, raised in a digital world, are more comfortable with ride-sharing, leasing, or simply going without. Many don't even see car ownership as a rite of passage. And older buyers, especially those burned by recent price gouging or depreciation, are deciding to delay purchases indefinitely. The entire model that supported the car economy, frequent upgrades, trade-ins, and status-driven shopping, is breaking down. For the first time in decades, consumers are stepping back not just because they can't afford a car, but because they no longer believe it's worth it. And with that shift, the old automotive model is quietly dying. Wall Street slept through the alarm. The collapse was already happening. Wall Street just did not notice. While dealership lots overflowed, loan delinquencies surged, and buyers vanished from showrooms. The markets kept trading as if everything was fine. Stock prices for major automakers like General Motors, Ford, and even struggling brands like Nissan remained deceptively stable through the early part of the year. But those numbers were based on press releases, not reality. Investors bought the narrative that automakers were navigating the storm with agility, that demand was stabilizing, and that new vehicle rollouts would drive fresh momentum. None of that was true. The truth was hidden behind clever quarterly reports, padded by fleet sales, rental agreements, and manipulated retail incentives that made unsold inventory appear as movement. Shareholders saw charts, dealerships saw silence. Even worse, the financial infrastructure surrounding the auto industry is more fragile than most analysts realize. Credit default swaps tied to subprime auto loans are quietly stacking up in bank portfolios. Commercial paper tied to vehicle floor plans and dealership financing is nearing stress thresholds. Yet Wall Street's risk models haven't caught up. They still think this is a demand dip, not a systemic collapse. Behind every uptick in a stock chart is a family trading down or skipping a purchase altogether. Behind every dividend projection is a dealership fighting to meet payroll. The crash is already underway. It just has not hit the indices yet, but it will. And when it does, the losses will not be confined to the auto sector. They will ripple through insurance, lending, and local economies. And while Wall Street holds its breath, Main Street is already gasping. Washington can't stop the fire. It helped start, the tariffs backfired. The subsidies dried up, and the political finger-pointing has begun. In Washington, the collapse of the car market is no longer a distant concern. It is a political wildfire no one knows how to contain. What started as a tool to punish foreign competitors has turned into a wrecking ball that is leveling domestic factories and choking middle-class consumers. Now lawmakers are scrambling for answers they do not have. On one side, Republicans call for expanded tax credits and deregulation. On the other, Democrats demand targeted bailouts and union protections. Meanwhile, automakers are caught in the middle, bleeding jobs and market share while begging for relief. State governors are already panicking. Michigan, Ohio, and Indiana are lobbying aggressively for federal intervention as plant closures ripple through their local economies. But Congress is frozen. Gridlock has made decisive action impossible. The collapse has also reignited the culture war. Some lawmakers frame the crisis as the natural result of Biden-era regulation. Others blame Trump-era tariffs. Both sides are right, and both are wrong, because the real failure was never ideological. It was structural. America built its auto economy on low interest rates, cheap global parts, and stable supply chains. Now all three are gone. As the debate drags on, the damage spreads. No one can agree on how to distribute aid or whether to intervene at all. The electric vehicle subsidy pool is nearly exhausted. Infrastructure bills are tied up in procedural battles. And while politicians argue, the system that moves American steel, rubber, and jobs is breaking down in real time. And that vacuum of leadership lets someone else seize control. Mexico and China just won the war. Factories are leaving, supply chains are shifting, and America is falling behind. While Washington argues and Detroit bleeds, manufacturers are making quiet but irreversible decisions. Final assembly lines are being relocated to Mexico. Battery and semiconductor contracts are being signed with Chinese firms. And component suppliers, once based in Ohio or Tennessee, are now moving operations to Southeast Asia. This is not a temporary realignment. It is the start of a permanent exit. For decades, America believed it could protect its auto industry through branding, innovation, and tariffs, but cost always wins. Mexico offers cheaper labor and better logistics. China offers scale, control, and resources that the U.S. no longer controls. Chinese firms now dominate the production of lithium iron phosphate batteries, one of the most important components of the modern electric vehicle. Without them, American automakers cannot compete, and with them they are becoming dependent. The big lie of the past 5 years was that reshoring was working, that factories would come back, that America would build again. But those announcements were press releases, not production schedules. Quietly, the opposite was happening. As costs rose and demand collapsed, manufacturers followed the path of least resistance, overseas. The future of car production is not American. It is international, and increasingly, it is not even Western. Brands like Toyota, Hyundai, and BYD have already moved aggressively to solidify supply chains far from U.S. shores. Even Ford and General Motors are investing more in Mexico than in some American plants. The dream of a domestically built, globally competitive American car. It is slipping away, deal by deal, factory by factory. And the worst part? It may already be irreversible. What this means for you, even if you're not buying a car, you are about to feel this crash. The collapse of the automotive market is not just a Wall Street event or a dealership story. It will ripple directly into your daily life. First, through your wallet. Insurance premiums are already rising as repair costs spike. Parts are harder to source. Labor for mechanics is short and expensive. Even routine maintenance is now a budget-breaking task for many households. Second, your community may suffer. Dealerships are more than showrooms. They are economic anchors. They fund local events, sponsor youth teams, and employ thousands in middle-class towns across America. As they fold, tax bases shrink. Layoffs ripple into surrounding businesses. The pizza shop down the street, the car wash next door, the coffee stand beside the parts department. They all rely on traffic from the lot. When the dealership dies, the neighborhood feels it. And then there's the personal cost. Millions of Americans are trapped in vehicles they cannot trade out of. Loans stretched over 6, 7, or even 8 years. Interest rates that ballooned mid-contract. Car values that dropped 20% almost overnight. For many, their vehicle is no longer an asset. It is a financial prison. And as resale values fall further, so does middle-class wealth tied to auto ownership. This isn't just a price bubble. It is a quality-of-life event. You may not feel it today, but you will when you try to refinance, replace, or repair. The car market was a pillar of the American economy. And this This was only the first wave. The car market collapse isn't just a distant problem. It's hitting home for millions. If you want to keep up with the unfolding crisis and what it means for your finances, make sure you like, comment, and subscribe. Stay informed, stay prepared.